who's a real angel sort of renaissance man, as an entrepreneur, a serial entrepreneur, an accountant, a venture capitalist. You have my heart because you led an angel group, so you feel my pain. And he's also the chair of the education for the Angel Capital Association. So we're really in for a treat with Kevin. I was at the ACA Southeast Conference. Kevin and Merrill Mason actually did a session that they're going to duplicate here tonight. And it was really fantastic and insightful. So I'm really excited to have Merrill Mason with us tonight as well. He is a corporate securities and startup attorney down in the Raleigh-Durham area. He also does some teaching at University of North Carolina, Keenan-Flagler. So really excited. I'm going to turn it over to these two gentlemen that are going to spend some time on term sheet, a lot of time on term sheets and a little bit of time on valuation. And hopefully we leave some time for some Q&A at the end. Thank you all for being here tonight.
Thanks. God. And Mason is a prolific angel investor himself, so he's working on both sides of these transactions. So it's great to be here with you. Just a little bit of my angel pedigree. I've been doing this full time for about 15 years. I started as a CPA, then I was an entrepreneur. I raised money before I knew that I was raising it for angels, and I sold the company before I knew the word exit way back when. And then I became a professor for a number of years and taught this. And when I retired from that, I decided to try to devote myself to improving the entrepreneurial ecosystem in my hometown, which is Boise, Idaho. So I've been doing that for a number of years. I've made about 60 investments. I have a services firm that provides services to angel groups around the country. And we just launched a new fund, which is a revenue-based fund. So maybe at the end we'll have time to talk about that if you want. And so Merrill and I did get to do this together when we were in Raleigh. So I'm really pleased that, he actually had to drive here and had to stop and recharge his car on the way. I just got an airplane and landed here, so it was no problem for me. We're glad to be there. This workshop is one of 7 that we have produced for the Angel Capital Association. And I think it's important to know we're all volunteers. We're all doing this for sort of the betterment of angel groups and improve the entrepreneurial ecosystem. And so we have a variety of instructors that put on our courses all over the country, of which this is one of them. Now, the bad news is this is designed for 4 hours. The good news is Monique said I couldn't have 4 hours. So normally we would have a lot more discussion and some case studies and things like that. That's gone away, so we have time to get through the material. We're going to go through it, and then hopefully we'll have a robust discussion at the end after kind of giving you the basic materials so that we can talk about what you want to talk about. So because of time, I'll skip the ads for the Angel Capital Association. You're all members of that. We got lots of members around the country, and we got great sponsors. And I do want to call out Seraph. This is a group out of Boston. This course is based on a book they have written. If you want to really get involved in term sheets and details, you go to their website and you can download it for free. They give away their materials as well. So with that, what are we going to talk about? So when we think about structuring a deal and think about terms, there's 4 pieces of this. There's valuation. We are, in spite of what Monique said, we're barely going to touch on that. That's a subject of another 2 to 3 hour discussion, but we'll have a little bit on that. There's the negotiations with the entrepreneur. I'm not going to do anything on that. But there are what are the terms and how is the deal in the company structured? And those are the pieces that we're going to hone in on tonight. Now let's just get a little overview before Merrill and I talk about some of the legal issues that are associated with this. So presumably most of you know this, but just to put everybody on the same wavelength, if you want to start an organization, what can you do? You're going to have a sole proprietorship. Many of you have done that. Some of you still do. You can have a couple of types of partners. You can be general partners. Nobody in their right mind does that anymore. They can avoid it. You can have a limited partnership. You can have limited liability companies, and we can have corporations. And 2 broad types from a tax standpoint. One, the corporation passes its income and expenses through the investors like an LLC would do, and the other is it's a tax-paying entity, right? So if you're active in this business, then you will see entrepreneurs show up with all these kinds of organizations, and there are some reasons why you might or might not want to invest in one that's organized that way.
But frankly, if somebody shows up and they're not an LLC or corporation, you probably just want to shut it down.
That's why I brought him. Okay, now let's talk about startup securities. Obviously, you can have stock. We're going to talk in great depth about that. But there's a lot of things that are not stock that could become stock. I understand the principal documents that you guys use here, the principal deals you're using here, or many of the deals are convertible notes, right? So a convertible note is a promissory note. It goes on the company's balance sheet as debt, and the holder of that note has the right to convert it, either upon the passage of a certain amount of time or in some event, or some point could ask to get their money paid back. Underneath that then are these weird things that have showed up. Have you guys seen safes and kisses around here?
No.
So like half the audience is nodding yes, and some are saying no. So we'll just talk about these for a moment, and then I'll ask my counsel here, just keeping me on the straight and narrow, whether he thinks anybody should invest in those. Okay? So what are they? Kisses and safes are contracts. You put money in, and the contract says, someday we may allow you to convert this to stock. Has typically no due date, usually has no cap, doesn't bear any interest. Why would anybody want to do that?
Companies love them. They're page long. What happens to me lately is the academic founders, come to us. They go out to the Y Combinator website, sign it up, and then send it to us. It's a security. It's not clear where it sort of fits on the balance sheet, debt and equity. It's very company favorable. But
Yeah, what the rights do I have?
none. And they're not defined until.
Did you hear that? None.
None. I mean, it's a terrible investor side vehicle.
We see a lot of them in California because they came out of Y Combinator in California, and so our entrepreneurs often show up with them. So I hope to help you understand this before the evening's over why if an entrepreneur shows up with that, you might just want to say no thank you and move on. Now we're seeing some other things. Revenue-based financing, this is a fund that I just created. It was a conference in Kansas City last week. You guys are starting to talk about that. It is a loan type of investment. I loan the company $100,000. They give me 5% of revenue until they pay me $200,000. That's the simple transaction. We're going to see more of those, I think. The advantages that those instruments have are there's no negotiation over money value. I don't care what the value is, and there's no need for an exit. All right, so that'll be another 4-hour seminar. And then there's a whole bunch of stuff, these tokens and cryptocurrency. We're not seeing as much of that. They were red hot 2 or 3 years ago. And if you see that and somebody wants to invest in one of those, run the other way and keep your hand on your pocket while you're going. That would be our advice for that. All right? Now, just to give you a little summary where we're going to go here of 4 common instruments. Price securities, which is stock, over here on the left. The granddaddy of it all is the National Venture Capital Association term sheet. It's in the back of your book. It's about 20 pages long. It covers a lot of contingencies. All right?
And it's also drafted by investors' lawyers, so it's completely investor friendly.
It's very investor friendly. Then next to that is this thing called the Series Seed round, and there is a Series Seed term sheet in your book along with the paper that I've written about it, and I hope before the night's over to convert some of you to the philosophy that this is a pretty good document. But it's a document that we can use to talk about the various terms and conditions. So the NVCA deal, I mean, it's got a lot of stuff in it, and it's expensive to do. The Series C document, the term sheet is a page to 2 pages compared to 20. Okay? So here's a philosophical statement. You're going to invest in a startup. One of 2 things will happen. It will fail, and you will lose all your money. Regardless of how good the lawyering is, how many documents you have, what your investors' rights are, you're going to lose all your money. Or it will run out of money, and you and other people will put more money into it. Right. So my philosophy as a as a seed stage investor is, you know, if they run out of money, I don't care. Well, I care, but I don't care about the legal documents. I just want to set myself up to get as basic protections, and somebody smarter than I, they're going to come along and write a multi-million-dollar check, and they're going to set a whole new set of terms out there, and I'd like to be able to participate in those terms. That's what we're going to try to do with these documents. Now, your convertible notes and your KISSes over there, and even in the convertible notes, you don't have much protection. You got some protection in this. If you don't have a cap on it, then you're really naked in terms of what's the price of the security is going to be that I'm going to put my money into, okay? And without additional agreements, you don't have liquidity provision, you don't have any investor rights or protections. So if you're going to invest in convertible notes, you might want to think about those kinds of things as we go forward. So we're going to focus on this Series Seed as an example document, talk about why you might like that stuff. Now, with that, I want to ask my pal, Lawyer Mason here. So, talk to us a little bit about the difference between investing in LLCs and investing in C corporations.
So why would that matter? I mean, you know, both entities, limited liability, right? They have a liability shield if you do it right. Perpetual existence, transferability. The challenge, an LLC document or an LLC entity is a hybrid between a corporation and a partnership. It was invented by an accountant to sort of get the tax advantages of a partnership under the liability protection of a corporation. It's challenging to do equity compensation. I mean, you can do it, but every time I say challenging or complicated, you should see legal fees, which is not necessarily bad. But
add another zero to the bill.
Let's ask a question. Can everybody hear? Okay.
Okay. So that, and then an operating agreement, which is a kind of a shareholder agreement, bylaws. It's the governing document for LLC. It's just complicated. It's filled with tax provisions. It's not. I mean, I've never read the operating agreement for my law firm, for instance. I have no idea what it says. There's that, and so you know, the accountants love LLCs. We hate them. Most lawyers. But the big driver for me is if you set up a corporation, a C corp, and you hold your shares for 5 years, potentially you can shelter $10 million in capital gains from taxation. I mean, that's meaningful, right? I mean, you feel like the capital gains rate is 25%, right? So that's a lot of money. So that's like a no-brainer to me. People set up LLCs all the time because they think it's easier. You know, from a legal perspective, it's kind of the same thing for us. But I think.
And then there's the flip side: if you lose the money, if the company goes under, if an LLC, you can't do this, but if you've done it right in a corporation, you can write that off against ordinary income, up to $1 million.
It takes there's some limits around that. But yeah, exactly. So that, you know, like for instance, in our angel group, we want to invest in an LLC. It's just a blanket proposition.
Have you guys invested in LLCs here?
Yes.
So the other problem with it, of course, is you can't do your tax return until they've done their tax return. And 100% of the entrepreneurs will promise you that that tax return will be filed on time, and you'll have your K-1 sometime in March, so you can do your tax return, and 99.9% of them will forget that as soon as times get tough. So you invest in LLCs, you're pretty well guaranteed you're going to have tax returns that you're going to file in October.
There's one other sort of technical issue. Like, you know, if I'm a member of the LLC, or if my employee's a member of the LLC, they're sort of entitled to see all the books and records, and they have to see the tax return. But oftentimes, I think you don't want everybody in your organization. You want to be flexible in what you're able to share.
So if we go to a corporation, generally speaking, we can have two kinds of stock. It can be common or preferred. Talk a little bit about the differences between those and why you might want to invest in one or the other.
So common stock is the lowest form of ownership, right? So that's what founders get. So you know, most of my clients, I mean, they're really smart because they pick me as a lawyer, and so their point is, well, why would I give somebody else preferred and me take common? I want preferred. But in the words of one of the local venture capitalists, there's got to be a screw E. I mean, it's got to be preferred relative to something else. And so preferred can be pretty vanilla, like the seed, and it can be as complex and elaborate as the NVCA form. So it's the rights and privileges above the common that make it preferred. And so it's dividend rights, it's governance rights, it's liquidation rights, it's blocking rights. Generally, preferred stock doesn't have the right to force a company to do anything, but you have to get their approval to take at least fundamental actions. Is that what you're?
Yeah. I mean, preferred means that my position is preferred to your position, right?
So there aren't, in any area I'm familiar with, like, investors won't take common stock. I mean, that's just it's a non-starter.
So, having said that, the biggest exit I had was common stock. I didn't have any information rights. I had no rights at all and made a pot full of money on it. That was before I knew it was stupid to invest in common stock. And I've often thought if that company had come to me now that I are a sophisticated investor, I'd have turned them down for that, and I'd have missed this giant exit. So there are no hard and fast rules in this business. When we started the education program, we thought at first we were going to try to teach best practices. And then it didn't take us very long to understand that there are no best practices. None of us know. So what we are trying to teach you are smart practices, which is a whole bunch of things that have cost lots of us money. Maybe you don't want to do those things anymore. So you take all this with a grain of salt as we tease each other back and forth and play with this, because clearly there's as many ways of investing money as there are entrepreneurs and investors. But as we go on, hopefully we can show you some of the things that seem to make sense to most of us that you might want to do in terms of your deals.
But one thing I think is important to keep in mind, I mean, I take your point with the concept, but I also think you want to set your company up to raise money in the future.
Yeah.
And so, there's some sort of breakdown for me of like to treat your earliest investors poorly. I mean, they're the ones that are taking the most risk. Generally, they have a personal connection to you, and you're able to take advantage of them because they're related to you or they're not sophisticated. Now, it just seems crappy. So, that doesn't sound real lawyerly, sorry.
Yeah, no, that's a good legal term, isn't it? Just in Virginia, they understand that here. Well, so I think, so have you have anything else you want to say about these other instruments, the KISSes and the safes, and there's all kinds of, there's some new weird ones coming out of New York now that I don't know what the names are.
Not really. So we are seeing more and more safes, and it's generally with the angel investors. I don't know, there aren't any institutional investors I'm aware of that are writing checks in North Carolina for safes.
Yeah. So what happens is we get entrepreneurs and somebody goes to Techstars and Techstars tells them they need to raise money on a safe, and so they come and they explain to you how they've been to this really smart place and you're really dumb if you don't take this instrument. And I mean that goes on a lot in this business. So use some if you really want in the deal and that's all there is, you have to make a decision, but you have no protections and no rights whatsoever. And when they go to raise money some other time, you may wish you had something to say about it, and you won't. So with that, let's move on a little bit here, and I'm gonna keep us moving and invite Merrill to chime in whenever he wants as we go forward. Let me just talk a little bit before we dive into this. What is a term sheet? And so, just to make sure we're clear, in the back of your book, the very first thing, Series C term sheet, okay? We got a copy of that there. It's one page. Behind that is something that I wrote to guide our angels in Idaho about, and what we decided a long time ago is we only do deals on this term sheet. We publish the term sheet. We say to the entrepreneurial community, this is our term sheet. I can understand you may want to have an LLC. Don't bother. We're not, go raise money someplace else. We don't do it. We only invest on this. Associated with that are the things that we agreed we'd negotiate. Everything else, it is the terms that are in the term sheet. If you can do that, that makes your life a lot easier and cuts the dickens out of your legal fees. Okay?
Scratch that.
I know. But remember, when they raise more money, they're going to need you for that great big $10 million raise that we're all gonna be happy
But
about.
I endorse that. I mean, if you can get that first round done on reasonable terms with no negotiation, I mean, you should do it.
It, you know, at the end of the day, he and she who have the gold do get to make the rules. And so I think you can be, you have to decide what your rules are and what you're going to be flexible on and what you're not going to be flexible on. But once we started to this, maybe the last 20 deals we made were all in this document. Boy, does that make life easier 5 years down the line when you're trying to figure out, do we get voting rights in that? Do we have, you know, what do we have? Get things standardized. Okay, so what's the purposes? The purpose is to kind of facilitate the negotiation. In our case, whoever's the deal lead will complete the term sheet. It gets signed by the entrepreneur. It gets signed by the chair of our organization. We're a fund. And based upon that, we then are ready to decide whether we want to invest or not. Here are the basic terms that the members are going to vote on and we're going to go forward with. Comes out of the, in our case, comes out of the due diligence lead. So we sent it out. It's a basis for finding interest. We do a lot of syndication around the West. And so if you're going to syndicate, of course, what are the terms? So here's the term sheet. We go forward. And it's not binding, right? This is what we've agreed to, but we can all walk away from the deal if we can't get there. And it's very helpful afterwards. When you have a question, this is always where I go to the term sheet before I dive into the documents. You know, sooner or later somebody probably has to read the documents, but it's awfully helpful to have that. Right? So, where I have pulled this from is a website called seriesc.com, and shame on me, I didn't look to see if there's been an update. The last time I looked, it was 3.2. This is a website, kind of a crowdsourced website, started by some of the major deal firms in Silicon Valley. To kind of say, hey, you know, when we're not doing all these huge documents, what are the basic terms? So you can go out and you can get this. The documents are free. Somebody will need to take them and conform them to whatever state law you've got. When we put that out, we say to our entrepreneurs, the documents will be identical to those listed at seriesc.com version 3.2. Not based on identical to, except for any changes agreed to in this term sheet or required under Idaho law. And the first time we put that out, you can imagine what counsel for the company said. She called me, she said, Kevin, come on, you know there's always changes. The last changes were like $20,000 worth of changes in the last deal we did. And I said to her, you know what? Our members last night voted on this term sheet. If there are changes you'd like to make, we'll be happy to adjust the term sheet. We next meet in 60 days and we'll vote again. Well, she said, well, that's patently unreasonable. So I said to the entrepreneur, do whatever you want. We're prepared to close under these terms and conditions. We'll give you your money. If you want to make changes, we're happy to look at them. We next meet 60 days from now. And we're not doing any more changes unless they go in the term sheet. Well, that little pushback changed the culture in our community. If you're going to get money out of the Boise Angel Alliance, all the transactions attorneys know this is what we're going to do, and we expect reasonable fees for that. And reasonable fees in our neck of the woods, if the corporation is clean, they don't have to convert things, they don't have a whole bunch of messes to clean up, the attorneys will do this for about $5,000. And we then take it to our attorney with a cursory review. And what we say is, first of all, we want a representation of the attorney. You didn't change anything in here. If you did, you got to call it out. If there's nothing changed, then our review tends to cost about 1 hour of the attorney's time to say, yep, it's all here, you can go ahead. So we've cut that tens of thousands of dollars with the legal fees that are coming out of your pocket, right? You're the one that's providing the capital to get it into the company so the company can go grow sales and not argue over documents. So that's what we're trying to do with this document. And once you get the community and the council in the community kind of all bought into this, boy, does life get a lot easier. You want to make any comments on that? Anything to say about that?
With my investor hat on, I love it.
Yeah. All right. So they're there. You can go look at them. You can download them. They're free. They're legitimate. They're done by top deal attorneys in California. All right. So let's dive into terms. So we're going to break them into 4 parts here. What are the economics, management and control, investor rights and protections, and what do we want to say about exits and liquidity? Now the items that are in red up there are in the Series C term sheet. The items that are not in red are not in the Series C term sheet. We're going to spend a little time on them so you know what they are and what you're giving up if you don't have them. All right. So we're going to deal in economics and just talk a little bit about valuation and capital. So the first thing in there is how big's the round, right? So we agree that we're going to invest $100,000 in a round of $500,000 with a pre-money valuation of $2.4 million, and we will write our check at the time you're ready to close $200,000. Sort of standard things that are in there. When you think about the round size, as you're working with the entrepreneur, and the entrepreneur needs money, he or she will take the money that you will give them, in spite of the fact that it may not be enough, or in spite of the fact that it may be too much. That doesn't often happen, but either is bad. So that think carefully with your entrepreneurs about the round. Here's what I want to think about. How much money does it take to reach the milestones that if you reach those milestones, the company will be more valuable than it was when I put the money in? If you think about it, if the entrepreneur and I have agreed that their business is worth $2 million, I'm going to give them $500,000. So now it's going to be worth $2.5 million before they do anything with it. I have great hopes that after they spend that $500,000, it's worth more than $2.5 million. If we give them too much money, you got a risk at the other end that they couldn't spend it profitably. If you don't give them enough money, you run the risk that they won't reach the milestones, they will run out of cash, they won't have achieved what you hope they achieve, and they won't be able to raise money at a higher valuation. So that thinking about the right size valuation is
So one of the ways we frame that up is, I like to see a slide that shows the amount raised, the milestones to be achieved, and the time. So when an entrepreneur comes in and says, I'm raising 6 months worth of cash, it's nuts, right? I mean, because you're going to raise that money and you're going to immediately look to your next round. So you ought to, if you're able, at least 12 months of cash. And then show us, as best you can, that you're going to use that. There's got to be a multiplier effect, what Kevin was getting to. You can't, if you raise $500,000 on a $2 million pre and now it's 2.5, when you spend the money, it's worth 2.5. That's not, we can't do that. You got to show us you're going to spend that, now it's going to be worth $5 million or 10 million. So it's that multiplier effect. It's got to be there.
I also like to see when I'm having these discussions with the entrepreneurs, how much capital are we going to have to raise to exit? I was reviewing a deck this morning on a deal that a bunch of us are involved in Boise. And, it's classic, it's $500,000 deal. He's got the hockey stick growth 5 years, so now he's going to be selling $50 million worth of revenue. And you go, well, you're not going to get there on a $500,000. How much more are you going to need? Well, I don't know about that yet. Well, let's think about that, because once you're in all the way through. So round size is always in the term sheet.
And
How
one of the
big is that
questions
round?
we ask in my age group, so it's standard questions like, what can you do with half the money you're asking for, and what can you do with twice the money you're asking for?
Wow,
And
great
frankly,
questions.
we don't really believe your answers. We just want to know you're thoughtful and you put some time into it.
Often, if somebody's convinced the entrepreneur they need $1 million, and and for most of us, they're not going to get $1 million in this round. So back to that. What can you do with less money that will make this thing worth more money than it was when we put the money in? That's the fundamental question to the size of the round, I think. Okay, valuation. Just to be sure we all can do the arithmetic, right? We start with what is it worth that the entrepreneur brought to the table? The dog, the pickup truck, and the crates and barrels that they have as an office, and whatever IP they've created. We call that the pre-money valuation. If you don't have this language, then you want to adopt it because it enables us to talk across deals in the same way, and you certainly want to require your entrepreneurs to use this language, you know. Oh, I'm raising $1 million and I'm gonna give you 10% of the business. I said, oh, so you have a pre-money valuation of $9 million. Well, how'd you get that number? Now, I don't, that seems like an awful lot. Yes, it does. So, pre-money valuation, that's the value of what the entrepreneur brought to the table. Investments, what you bring to the table, you add the two together, and you got the post-money valuation. And you divide what you put in by the post-money valuation and what the entrepreneur to get the percentage. Okay, everybody with that? That we could do a whole course on that. You might want to bring in Bill Payne, who's the principal instructor, to talk about how you arrive at those numbers. And we just say this varies, valuations also vary by marketplace. So we're the only game in town in Idaho. And as a consequence, our valuations are lower there than they often are elsewhere. It's probably justified because our entrepreneurs are less experienced too. And you know, periodically I have somebody say to me, well, you know, if I were in Silicon Valley, I get a $5 million valuation. Good. Go out on the freeway, when you get to Nampa, turn left, when you get to San Francisco, turn left again, let me know how it works out. You know, your valuations need to be in accordance with your region, because that's where these people are gonna raise their money from primarily. So we have a conversation in the Northwest every month amongst the region, amongst the 10 or 15 angel groups. What are they doing? What valuations do they see? What are we, you know, we share that information back and forth so that we try to stay in accordance with the valuations in the region. As a consequence, we don't do much investing in California. Their valuations are significantly higher.
So sort of rule of thumb in the triangle is, you know, if you're a pre-revenue startup, you know, your range, you're probably $1.5 million to 2.5 pre, right? And we have a bunch of models we can show you, but the dirty secret is if you raise money at less than $1.5 million, likely the founders aren't going to own enough when it exits. And that I can't tell you that, you know, empirically.
Yeah.
It's just a fact. And so, and if you raise money much more than that, the investors can't show the potential return they need to show across the portfolio. And so, you know, it's just a rule of thumb, but it fits mostly. The other thing that's happened a couple times recently, I know
No, we're all
taking too much of your time, but we've had a couple of local companies that have raised money at too high pre-money. And so they were able to do it. They went out of state, or they had done this 2 or 3 times. And the way that played out in these 2 examples, they got ahead of themselves. So they raised a Series A at a pre-money that they couldn't support a Series B. Or in one case, I'll tell you what it is, it's WebPix, terrible investment OS, but they couldn't sell it, right? So if they had raised money at, you know, $5 million pre, if they sell it for 50, they're a hero. They went out and raised money on the West Coast at a $50 million pre. Now you got to sell it for $150 million. They couldn't do it. I mean, it was like, it was just the lack of forethought. You know, they just thought, I'll get the best deal I can get, and it wasn't the right decision.
Yeah, so I think you make a really good point. It is, you know, we are capitalists and investors, and obviously we want to get the best deal we can, but I think we're also mentors and supporters of the entrepreneurs, and often we've got to counsel these entrepreneurs and work with them and help them not make mistakes that will really hammer them. My overvaluation story, one of the early ones we did, $5 million pre, we wrote the check, kept not making his milestones. He was expert at raising money, kept raising money, got a little institutional money in. And at the end of the day, what does the next guy in do? Well, I would like more preferences. And he had so many preferences in there that they had to exit for $35 million before our round got anything. And I think it sold for like 6. So you can do all kinds of tricks to make valuation feel like it works, and if you stay out of that, the less decorated you make these terms, the better it's going to be on down the line. So, liquidation preference, we talked about that. So, usually, one of the things in preferred stock is, I want to get paid before you do. Couple ways of doing this. One is what we call non-participating. I invested in this preferred round, and when there's an exit event, I have the right to either take my money back, or I have the right to convert to common stock and take my pro rata share. Participating preference is sort of a double dip. I have the right to get my money out, and then I convert and take my pro rata share. That's very common in in VC rounds and upper rounds. It typically is not common in angel rounds.
If you think about it, the liquidation preference was designed for downside protection, right? So, I invest in your deal, and you may have a chance to sell it for $3 million, and you own half of it. $1.5 million to you personally, that's important to you. But if I'm just going to get my money back, that's a terrible deal for me. So the liquidation preference gives me that downside protection.
Yeah. We've had one deal in our history where they had a terrible exit, we thought. And the entrepreneur, he was burned out, didn't want to go on any longer, whatever was going on in his life, and so he wanted to sell the company, and he got a little cash and a huge potential payout based upon earnout. And we took a look at it and said, he'll never make the earnout. Tell you what, we'll just take ours off the top and we'll walk away from it. And you, Mr. Entrepreneur, and you can have all the rest of it. And if you make that earnout, hallelujah, good for you. We'll take our money off the table. So it is a useful thing. In the Series C document, it's phrased as a 1x, one time your money back or convert. The other thing about it, people can get greedy. Well, I want a 2x participating preference. Just remember, you're not going to be the last capital in. We're early stage investors. Whatever you put in there, the next guys in, or gals in, are going to take that and more. So be careful what you wish for. All right, liquidating preference. We did that. Right now, the ACA has now created a database. One of the problems we have in this industry, we don't have good data. All of us, I've already told you about the one big exit I had that I took common stock in. I haven't told you about my losses. They're not as fun to talk about. And so we have started, you guys are contributing your data to
Hockey stick.
yeah, the hockey stick. So we're trying to create a database. We've got now 3,000 or 4,000 deals in it. We've got 160 angel groups around the country. We're going to get a lot of good data that's going to help us make better decisions. So far as we know right now, if there is a preference in the investment by an angel, less than 25% of them are participating. The common thing is a non-participating, take your money back or convert. All right, now let's talk about options. And that's in the term sheet, and for most of us, these companies shouldn't try to raise enough money to pay market salaries. That's going to take an awful lot of money. So how do we get people to come to work for it? We say, we'll give you a piece of the action. We'll give you some options. Well, let's go through some arithmetic with the options. The term sheet says there will be an option pool of X shares. How do you arrive at X shares? In our case, we run the arithmetic and we want that X shares to be 20 to 25% of the post-capitalization structure of the company. Okay? So if we invest, let's make the math simple, let's give them $1.5 million pre-money and we put in $500,000. $2 million post, we get 25%, the entrepreneurs get 75%. We would like those options to come out of the entrepreneur's share and not ours. In other words, we're saying we want 25% of the company after everything is done. Okay, is that my example of it? If you don't have any options, I get 25%, and founders got 75%. If I got the options and the options are done before I put my money in, called the pre-money options, I still got 25%. If, on the other hand, the option pool is done after I put my money in, well, look what happens to it. I only have 21%. That effectively increases the post-money valuation of this. So you want to be very thoughtful. And the entrepreneurs, most of them are not going to understand that, and sometimes their counsel doesn't understand that. We want to come to an agreement what the size of the option pool is going to be before we write our check, and our check will get that 25% after all that's done. And we always figure that on the fully diluted as if all those options have been converted. Because if the company is successful, they will be. And there'll be more options down the line.
Kevin, one of the ways I think about this is the option pool, there's a plan for your options, right? You have a hiring plan. And so that builds up, I'm gonna hire, these functions and these roles. And I think I'm gonna ascribe a percentage option to each one of those roles. And I want the option pool and the money to run out at the same time, right? So I'm not trying to
Right.
create an option pool that's gonna last for 5 years. If the money's for 2 years, the option pool, at least nominally, ought to be
Sure.
sufficient for 2 years. That's the way I think about it.
I agree with that. And if it works, then the value of the whole package, options, everything is more than what we put into it.
So what if you do if you're investing in an LLC?
You don't invest in those.
I knew
The
that
question
your
was, what have you invested in LLC?
To this point.
You can do the same thing. I mean, what's happened with LLCs, and it's awkward from a drafting perspective, is people have sort of, lawyers have kind of taken all the preferred stock attributes and put it into membership interest. So there's a way to do it, but it's complicated. And remember, that means legal fees.
Complicated dollar. The other thing I would say as a layperson, maybe a comment on this, is the corporate laws are really well understood, really well litigated. An LLC, every LLC is a contract, it's different. And somebody wrote all this for you, but if you come to an argument, you may end up litigating whether that actually says what you thought it said.
Right?
And that's, I don't want to be in that, I don't want to be in that case.
We're looking for certainty.
Okay? Okay, dividends. Now, there are no dividends in the Series C stock doesn't bear dividends. You can have dividends, and lots of preferred stock does, and it could be dividends that are paid in cash. It could be dividends that accrue. It could be dividends that say, well, if you ever pay dividends, I want them too. And some angels have used these as a way out of zombies. Merrill and I were talking about it. You know, we got stock, and after 5 years, it'll begin to, dividends will begin to accrue. You'll have to pay them. I got one of those now. I've been in it 10 years. It's a lifestyle company. Those guys are really happy. They got their corporate jet. They got, their fancy offices. They have no intention of selling the business. I wish I had some dividends or something that would make it painful for them not to take me out. But generally speaking, at the Series C stage, early stage, we don't see dividends. You don't see dividends, I'm sure.
Not the Series C, but think of it as interest. I mean, that's essentially what it is.
And then this last comment, remember, I made that point earlier. Whatever you ask for in the next round, if you ask for dividends, certainly the people that come in after you are going to get them, and they'll get them before you do, so be careful. Okay, so that's a little bit about deal economics. Let's talk about management and control. So when you do a convertible note, you guys do a lot of those, you got some of the deal economics in there, you got some money, you're doing capped notes now. So in essence, you're putting a valuation on the company. It's going to convert at a discount, the lesser of 20% off the next round or this price, okay? So you got a little economics in there. Now we get into these things that you don't have in a note that might be important to you. So management and control. What degree of control as the angel investor do you want to have over this company? And let's start with, none of us want to run the company. That's not the point. Some of us have done that. I never want to work that hard again the rest of my life. I don't want to run the company, but I might want to have something to say about what's going on down the line. So this is the place where we can do that. So often we will say this round of stock will have the right to elect a director. Now that right will often go away if there's bigger, more sophisticated money that will come down. That's all right, I got the company where I got it to, and now there's more important people. But so we often will do that. Typically, we might say something like there'll be a board of directors of 3 people, one of which will be elected by the common shareholders, that would be the entrepreneur presumably, one of which will be elected by the Series C stockholders, and a third which will be elected by all the shareholders together, generally agreed upon by those people. I think that's a sort of a shared governance model that works pretty well in an early stage company. Could be 5, some odd number. That's one way of assuring that somebody is going to watch the shop and somebody's going to insist that you get information. I went on the board of a company a while back. They're doing fine. They were terrible at reporting to investors. Finally, I got elected to the board. In the first board meeting, I said, henceforth, there will be, I'm making a motion that you will report to the shareholders by the end of the month following each quarter and by the end of the month following the year. Everybody, okay. Now you've got something there that when they don't do that, you can call up the CEO and say, your report was due yesterday, where is it? Is that perhaps more than any other thing irritates angels and happens to us all the time? They take the money and you never hear from them again. All right, but board. So, do you want to have a board seat? When we do this, we specify who the board members will be. We don't specify it in the term sheet, but we come to agreement before we write the check. Okay, you know, we're gonna do this, and Monique is going to be our director elected by the series seat, and this person and that person. Otherwise, you can end up with one investor and a wife and a husband, an uncle, a whole bunch of other things that go on. So make sure you're in the power before you write the check to try to help these people have good governance. And one is to have a real board of directors as it goes forward.
And have real meetings.
And have real meetings. And if any of you are serving on boards, we've got a dynamite course to scare the hell out of you called Serving on Startup Boards of Directors. We wrote that, did it for the first time in Cincinnati last fall, and I went through the course. I thought I was auditing it to see how the course was, and I went home, called the two CEOs of the two companies that I was on, and said, we have to change things. I don't like having my butt hang this far out. So, but, okay, I moved on. Did I hit that? I moved fast, I'm sorry. Okay, board seats, all right. Investor information rights. Okay, there is no obligation once the company takes your money to ever tell you anything, right? Other than what few things that shareholders have the right to vote on. But it doesn't say I have to report to you periodically, right? So, I put my money in, I'd like to know. So, let's put some information rights in there. In our case, so Series Seed has that, you know, you can get basic reports. We specify, okay, by the end of the calendar month following each calendar quarter, you will provide us with an income statement, a balance sheet, a cash flow statement, a capitalization table, and a narrative from the CEO as to how things are going. Now, do we always get it? No, but at least it forces the conversation before we make the investment. Listen, Ms. Jones, if we're going to invest in your company, this is what you have to do for us. Are you prepared to do that? And it makes it a lot easier. And then of course, the first time they're 3 days late, you want to call them up and remind them that you're watching to do that. So that's one of the real nice things about being able to have preferred stock is I'm going to require information rights. There's a bunch of things you can do. You can decide what it is that's important to you. Of all those things, to me, I want them to give me the cap table because I want to make sure I know what's going on. And I want the narrative from the CEO, what is going on, so that I can have a conversation with them about it.
We'd like to get ahead of any problems we can. We'd like to be helpful when we can. If they're having trouble getting to a particular customer, somebody in your group can help.
Yeah. And, you know, for the most part, we're investing in young people. And for some of them, it's really hard to admit when things are not going well. And so you want to try to make it all look good to your shareholders and tell them all this stuff, and it's great, and we can't help. So getting them in a deal where they are reporting to us and telling us what's going on so that we can, if we know somebody can help them, we can connect them. Okay. Now, this one called Founder Issues, sometimes called vesting. What this says is, all right, Madam Entrepreneur, we go through all this. When we're done with our financing, you own 75% of the company. We want to know if you leave in the next 5 years, we want the right to take that stock back from you. And they go, oh, you can't, I've worked hard for that. No, understand that. But we're relying on you as the CEO of this company. That's who we're investing in. We know there will be pivots. We know some of your technology won't work. We know the market won't behave the way they think. We're betting on you, and we want to know you're going to be there. And if you leave, what do we have? Well, if we don't have any of that person's stock, we're in a world of hurt because we're going to go try to hire another CEO and give them options to try to compensate them for it. So This one is a really important one to me. And if there's more than one entrepreneur, there's a team of them, guaranteed one of them will leave. In my first business, my partner did that. He got fed up and he left, and he walked away with 25% of the company. I worked for 5 more years to get the company to an exit. It really pissed me off, if I can use that
This
phrase.
is showstopper for me. Like, I won't vote for a deal.
Yeah. You've got to have a right to, and once you can get the entrepreneur to understand this, it's like, well, do you plan on working with this until we get an exit? Well, yeah. Well, then, all I'm asking you is if you don't, our deal's different. Now you can, there's provisions, if they get sick, if they die, we're not trying to be,
And it can be waived by the company.
and you waive it at the time it happens. So this is a really important, I think, right to have, but mostly it's important for the conversation it will force you to have with the entrepreneur about what are his or her real intentions. We did have one where we invested, and 2 weeks later the partner left, and boy was the guy that we forced into this happy that we got all that partner stock back so we could use it to compensate other people. So founders, issues, sometimes called vesting. You can do some other things. This one up here, it's really important that we get everybody to sign off that any inventions that they've created belong to the corporation. Right? So that typically is, there's a non-disclosure and assignment and all that kind of stuff, but you do not want to invest in a company that doesn't have control of that IP. So that's usually part of the package. You got any terrible war stories about that one?
Well, there's one in the news recently. Remember the WeWorks guy?
Oh, yeah.
Filed a trademark registration and then sold it to the company? Like, how crazy was that? It was, I don't know, it was like $5 million.
Yeah. So make sure you get those assignments. Ask for a representation of that. That's in the term sheet, that all intellectual property will be assigned.
And these are super hard to do retrospectively. Like, if you don't get it done now, now I call somebody in Boise and say, hey, we were good friends 2 years ago. Can you sign this? Like, that's a great conversation.
Oh, yeah.
Well, how are things going? What's it worth?
Yeah. And when you have an exit, the due diligence attorneys, if there's intellectual property involved, are darn well going to go audit that. And if you don't have all those assignments nailed down and they want to do the deal, then what they will do is they will escrow a large portion of their purchase price and put it over here saying, just in case, Monique comes out of the woodwork and says she owns a little piece of that code there, we're going to hold this for the next 5 years. So get that done.
She's shady. You go.
All right, how are we doing? We're doing great. All right. Investor rights and protections. So in addition to information rights, you may want to have some blocking rights or some things that you say, look, we made this deal and you can't go over here and do something totally different without my permission. So let's talk through some of these. Okay, approval rights. That says you can't change the bylaws of this corporation. You can't do a bunch of things without getting a majority vote of this class of stock. If you don't have that and they require shareholder improvement, then it's a vote of all the shares. And since the entrepreneurs have got more than you do, they're going to be able to move ahead. So putting into this some sort of approval rights on things that might be important to you. Raising more money, selling a building, buying,
Changing out the management team.
changing the management team. Every deal is different, but at some level, you want to put in there some rights. And again, as part of your negotiation with the entrepreneur, and none of us, you don't want to slip these things. We're not trying to slip this by the entrepreneur. We want to have a discussion with the entrepreneur. When's the next time we're going to raise money? Are we all agreement? So we're going to sign a contract that says you won't do that, different than that, without coming back and making sure that I'm on board with it. Okay? We have a phrase here, and that's because Bill Payne wrote this, and some of the laws are a little odd in the West. Try not to require shareholder approval unless absolutely necessary. We have some of the things in Idaho require 100% shareholder approval to do certain things. Well, soon as one of them dies, you're in big trouble, and you can't find them and all that kind of stuff. So you may want to work with your attorneys, and I don't know what your corporate laws are in this neck of the woods, but you want to get as much of these things approved by the board of directors rather than by the shareholders. And remember, we've elected somebody to the board for that. Maybe we ought to comment, just to make sure we all understand, when we elect somebody to the board, that person is elected by us, but they're not our representative. You want to comment on fiduciary responsibilities of directors?
I had this conversation for an hour this morning, and somebody was going to pay me for it, but.
Heard it free, right?
So,
It came with food.
somebody says I'm a
Why?
Series A director, and that, on this board call, somebody said, well, I'm representing the Series A. I said, no. The law is absolutely clear. You represent all the shareholders, and there's just no question about it. But I hear this with, grizzled VCs, just don't get it.
I got it now.
I'm looking out for the preferred. No, you're not. You're looking out for the shareholders' interest, meaning the body of shareholders. Another nuance here, and I don't want to get too far down the weeds, but
All right.
so, we put these, we call them consent rights or blocking rights or vetoes. We put them at the board level or at the shareholder level. So sometimes we'll say, all right, you can't do these things unless you get, approval of the board with shareholder, Series A director, right? But when you're at the board level, you have to act in the best interest of the shareholders. If we move that approval right to the shareholders, you can vote however you want. The sky's not the right color for you today. So with your investor hat on, you have to balance this, but you'd rather have more things that you could vote as a shareholder rather than as a board member, in my opinion. That's a nuance that we don't need.
I'm on the board of a company that we're putting into bankruptcy. That's not fun. And then the lecture you get about your fiduciary responsibility to the creditors is a whole new world too. So be careful if you're going to be a board member to make sure you know. But in terms of what you want to do, it's very easy to put these basic rights in there so that at least you're at the table when they come along. They're going to sell stock and it's a big down round and somebody's going to put a whole bunch of preferences in there. You may want to block that. Or you may want at least a right to have something to say about it. It'll bring you to the table as we do that. Okay. Participation rights, also called pro rata. And this says, when I finish this round, I own 10% of the company. The next round that comes along, I have the right to buy as much stock that would protect my 10% of the company provision. And that if you've got a company that is going up, you want to have that right. You want to make sure that you can continue to buy in as more money comes in, at least to the capability of your pocketbook or your group's pocketbook. So
This is a place we'll negotiate pretty hard. Oftentimes the companies will say, we'll only give preemptive rights to help define major investors. And so most of the angels will fall below that. So we'll push back and say, well, you got to aggregate all of our triangle angel partners. And so we'll be considered a major investor. But that's a place to need to be careful and pay attention to.
Often the terms will be limited to major investors and they'll be defined. And I've always said in our group, hey, any shareholder at our level gets these rights. If you're going to choose to take $100 from somebody, they get the rights. Don't do that. Now on down the line, when bigger investors come in, some of those may go away, but it's important to, and I think it's part of what we're trying to do because we're investing as groups. We're investing. Some people write a $100,000 check, somebody else writes a $5,000 check. We're all part of the same group to get those rights for everybody. Okay. Anti-dilution. So basically what this says is, I bought the stock at $1 a share. You sell stock at 50 cents a share to somebody else. I've got a right to reprice my stock. And there's a bunch of algebra that goes with it. Maybe you sell one share of stock, somebody else at 50 cents, I got a right to reprice all my stock. The euphemism for that is a full ratchet. And generally, we consider that to be pretty punitive. And so you may have a weighted average anti-dilution provision that says, well, if you sold 10% more at this price, then I've got a right to reprice the equivalent portion of my stock. Boy, that is nice to have if the company has a down round. Although I would tell you that in my experience at the stage most of us are investing, if they have a down round, it's probably on the way to their going out of business. You're going to lose all your money anyway. So we don't normally put this right in the Series C document. You can if you want. It's a good discussion to have with the entrepreneur. Okay, particularly if the entrepreneur is pushing for a high valuation. You say, well, you know, I think tell you what, I'll do the deal, but if you ever sell stock at a price lower, I get to convert it, I get to reprice all my stock at that same price. And once they process that, that will enable you to kind of reprice the deal.
So I love this provision because it's heavily negotiated and lots of legal fees. I'll tell you, there have been a couple of academic research projects on this, and you're exactly right. In the early stage, if you have a downrun, companies rarely recover. So you have this right, and it's a good thing. It's sort of it's table stakes in the triangle. We always we get weighted average.
Yeah.
But I'm the same way. I'd rather, with my investor hat on, I don't care.
Everybody decides. So I think that's the reason it's not in the standard Series C term sheet. But you know, depending on how big the deal is and the velocity and all those kinds of things, it might be useful to have that. So right of first refusal, what we're trying to do here is, hey, if the entrepreneur decides to sell some of his or her stock, what's going on here? Now, it could be that they're just in a liquidity crisis. It could be that they're that guy with WeHorse. He needed to upgrade his 787 to a bigger plane. Okay. We're saying if you're going to sell your stock, you get a bona fide offer, the company's got a right to buy that stock back at the same price, and if they don't exercise it, then we as investors have a right to buy that stock at the same price. So you got to give us that right if you're planning on selling the stock to allow us to protect our position and keep that stock from maybe wandering off into another tribe that we would prefer not to have. Okay? Now, the co-sale is the other side of this, which is the entrepreneur's got a chance to sell 100,000 shares at $10 a share. We decided we don't want to buy the stock at that price, but we'd like to sell some of our stock too. So the co-sale says, well, if you sell 10% of your stock, we get to sell 10% of, in other words, we get to supply some of the shares at that same price. Again, these can be useful, but at the Series Seed stage, remember Learned's law, they're either going to lose all the money and you go broke, the company goes broke, you lose your money, or there will be more sophisticated money that will come in on top of us and they'll change all these provisions. So I don't get very wound up about these at the Series Seed stage, but I want you to, those are out there, you may see them in the documents. All right, now we want them to sell this bloody company because we can't get any money if that doesn't happen. So what are we going to put in the document about liquidity and about exits? What are we going to do here? And so here are 4 terms. None of them are in the Series C document unless you choose to add them. One of them we've added to our standard document, and I'll tell you about that. So this is the right to block founder transfers. Is sort of the flip side of this. If you sell some stock, we get to buy it. If we don't buy it, we get to sell. You could just have it, hey, we're gonna prevent you from doing that. Okay? So these provisions, they're all in the NVA documents, in NVCA documents. It's getting late, and that's what they're trying to get at here, is to try to keep that entrepreneur from selling stock underneath us or bringing in some partner that you would just as soon not have. Drag along rights. This one, excuse me, I didn't mean to go that far. Drag along rights, go back, is the one thing that we have added to our term sheet. and it says if most everybody agrees we're going to sell the company, you can't object. And depending again on your state law, if you, in Idaho, if I'm objecting, I can force the company to do an appraisal, I can go through a whole process to say, I don't agree with this. And so we want everybody who comes in to say, if a majority says we're selling the company for this price, you are drug along. You don't have a right to object to it. We think that's an important provision. We've had several instances where somebody objected and we thought it was unreasonable. There was an objection probably based upon some family issue, someplace that somebody was mad at somebody, all that. So that's a good one. I like that one a lot.
So oftentimes the buyers will say, we'll buy your company, we'll buy the stock of your company, but you can't have anybody who's objected, or you can't have more than 5%. So what you end up with is sort of this recalcitrant shareholder who's got undue leverage. So if you have a drag, you eliminate that.
Redemption rights. So what a redemption right says, and one of the boards that I'm on, we are faced with a redemption right coming up next summer. The redemption right says under certain circumstances, typically it's a passage of time, the stock that I bought from you, I have the right to sell it back to you at some price. And it could be at what I paid, it could be fair market value, whatever that is, it could be formulaic, and sometimes we call it a put. And it's a nice option if you're in a company that's doing okay but is not moving towards exit and you'd like to force a discussion. The one I told you about where they are very happy with their lifestyle company, we don't have that. And boy, I wish now, 7-8 years into it, we had that to force that discussion. And the company that I'm on, the shareholders that purchased this particular series of preferred stock have the right to put it back to the company next summer. And they have the right to put it back at the price they paid. And we've had a 409A appraisal done. I'll tell you what that is in a minute if you don't know. And the price is a little bit less than what they paid. Boy, we'd sure hate to have to buy that stock back at that price. So we're going through the process of notifying everybody and hoping that they don't do that. Okay. 409A is a provision in the tax code that says thou shalt not give away options for less than fair market value or nasty things happen, tax-wise. And the protection for that is you have an appraisal of the stock made by somebody who's a qualified appraiser and says, in my opinion, the value of the common stock today is $12.37 a share, and then when you go to grant your options, you do it at that price or higher. I got that right, Counselor? So, but this could be useful, and it went out and out. Are you seeing that here, Puts?
I actually think we've always had redemption rights, and it's pretty illusory, as you said. I mean, if the company's doing well, you don't want out, mostly. And if the company's not doing well, they have the money to buy you out.
Yeah.
But it's just a lever to have a conversation, to force the conversation. I'm 100% with you. I mean, I've been doing this a long time, and twice in my career have I seen redemption rights exercised. I mean, it just never happens. But it's you don't need them until you need them. So.
Yeah. Then you wish you had it. Okay, registration rights. So if you can't sleep tonight, open up the NVCA term sheet and read about registration rights. And I guarantee you, after you wade through the 8 pages of that, you'll be asleep. Okay? What it says is, hey, if you actually take this company public, then you got to register our stock along with whatever other stock you're registering, because you know, under the securities laws, the stock isn't registered, you can't sell it. In the 60-some investments that I've made in my career, I'm yet to have my first IPO. Some people have been fortunate to have them. We don't have many of them in Idaho. So it's a lot of complex language, runs up the lawyer's fees. I'm happy not to have that. If sophisticated money comes in behind us, they'll put it all in. We hope to all get that.
It's a perfect example of the sort of most favored nation, where you say, I don't care about registration rights at this point, but if you give them to somebody else, you give me equivalent rights.
Yeah.
I think that's a great
We've got that phrase, as a matter of fact, thank you, I think that's the next, here it is, future rights. So this is the secret to making this document work, all right? The Series Sage stock will be given the same rights as the next series of preferred stock, other than whatever the price is, right? And what we're saying is, we've agreed, Entrepreneur and Entrepreneurs Council will give you this simple set of terms. It's pretty straightforward, we haven't asked for a lot. When the next group comes in, whatever they get, we get at the price of the stock that we pay. And some people have said, well, the next group will always object to that. That's not been my experience. If you've got simple docs, you haven't asked for the moon, you haven't asked for a 12x preference, you haven't put a bunch of stuff in there, we've found that the next level of investors in our funds have been happy to give us that right. So that gives you the, if it doesn't go broke, more sophisticated money will come in, they will do all the work to get all these rights, and I'll write on their coattail as they go forward. That's, you're using that?
Yeah, you've used it for a long time.
Yeah. All right, now, had we had 4 hours, we would have told you a lot of stories about each one of these, and we would have given you some exercises to work on amongst yourselves, and we would have poured more wine or beer. But we're not there. We've got now some time to talk about whatever you'd like to talk about. So who's got a question that you'd like to pose? Yes, sir.
What do you think about jumping in at the time of Series A versus Series B? What's been your experience with, you know,
So coming in as an investor, well, of course, none of us really know what seeds A, B, C means. There's this kind of presumption that they're further down the line and all that. I think it depends on the economics of the terms. I prefer to be I like working with entrepreneurs and helping them. And it's been in some deals where I've been in as a seed stage investor, and then they've had additional rounds, and I participated in those rounds. But I've never invested myself at a later stage investment. It's just not part of my own hypothesis in terms of what I want to do.
So I'd say it's sort of, for me, it's the risk profile in that pool of capital. So for me, like this portion of my portfolio, I'm swinging for the fences. If I don't think I can make 10 times my money, in the best case, I'm not going to do it. And it's just personal. But I also think it's more challenging as an angel investor to get in good Series B deals because you're competing with huge pools of professionally managed money.
They typically don't want little investors, right? Just screws the deal up. So they're putting in $5 million and you'd like to put in your 50,000 and probably they're, you know.
I mean, I've done so many deals, but I haven't seen that.
Yeah. Well, as we said at the beginning, you know, we think these are smart practices, but they're certainly not guaranteed, and every deal is different. So personally, I'm with you. This portion of my portfolio, I'm trying to support entrepreneurs, help them grow, and hope one of them will be successful and make me a ton of money.
So the only one I made a ton of money was my first angel investment in 1995, and I'm trying to capture that again for 25 years now.
That's encouraging.
True story.
I'll give you the first one I did.
Well, I thought it was a genius too.
Yeah, oh yeah, that's the problem. If you are so lucky to make money the first time in as
money in 3 years.
yeah.
Man, it's a piece of cake.
I had that. I invested in this company right after I sold mine. I went on the board of directors. It was the go-go days of the 90s. Some publicly held company that traded in the pink sheets or something came along and offered stock for the company. And we'd gone at $1 a share, as I recall, and they had offered, their stock was worth $3 a share. And I was on the board, and therefore I was going to be locked in for a period of months. But I told all my friends who went, I said, these guys, I don't trust them. You should sell your stock the minute you can. By the time my lockup expired, the stock had gone to $33 a share. I made a shit pot full of money in a listed stock.
We got sort of a legendary story.
And I had a lot of people mad at me too. That one was pure luck.
One of the guys that started Cause, he sold their business. They were going public, and a public company bought him out of the IPO process, and he was locked up. And his shares at the time were worth $40 million. I mean, he's a workaday guy. He worked for a newspaper. And the company went bankrupt before his lifetime. So he went from, sort of generational transferable wealth to
Yeah.
looking for a job. It's a terrible story. And he did everything right. I mean, life didn't cooperate.
Who else? Monique, you raised, yeah.
Yes, I have some questions.
Can you talk about the 10 million tax shelter, how real it is? We've been hearing a lot about it, but when I asked anybody has had an exit who had that, I think it's 3C certification or whatever, for the, how real it is, I mean.
It's real.
It's real. Yeah, I mean, unfortunately, we haven't had that many exits to struggle like I point to recently. But it's sort of, for me, it drives the decision whether to go the LLC route or a C. And if you start as an S corp, you can't ever take advantage of it. With an LLC, if you convert to a C, that's when your 5-year clock will start. But I just think the potential benefit's so great.
So let's, for those of you not quite sure what we're talking about, there's two provisions of the IRS, Section 1202 and Section 1241. You don't have to look them up. If you're really curious, go to the ACA webinar archives, and I did a webinar on this topic with a CPA, okay? And what they say, and of course, they're not exactly parallel, but if you invest in qualified small business company stock, convertible notes are not stock, and in the case of the gain, you hold the stock for at least 5 years, and you sell it, the taxes are zero, the federal taxes. Okay, and then you may never have noticed this, but there's a little place on the capital gains form where you can say it's section 1241, is that the gain? 1244, excuse me. 1240, anyway, 1244. There's a section you say this is 1244 stock and the tax is zero. Okay, and I've had that happen 2 or 3 times. It makes you feel so good. There's some limits and some things you've got to do. The other side is the downside. If you invest in qualified small business stock, the definition, of course, is slightly different, okay, and you lose your money, you can write that off against ordinary income rather than taking it as a capital loss.
So you can write that loss off quickly.
Yeah, I've had more of those than I care to admit to, but it does make it feel less painful if I can reduce my taxes, my ordinary income, rather than it going against capital gains. So to do that, the number one thing is it has to be stock, and you have to hold it on the upside for 5 years. So if you invest in a convertible note, that is not stock. The holding period starts when you convert the note. We had one deal where the company was an odd deal. We already had some stock, and they sold a convertible note, and we exercised the day we bought the note.
So I have a question. How does the IRS view the opportunity zone versus the 1244? Do you get them both?
I think so.
You get them both.
Okay, so
I don't know that for a fact.
the question is opportunity zone. So if you invest in a company in an opportunity zone,
The step up.
what you can do is, first of all, you have to have a recent capital gain
Right.
that you then invest in that, so you get to defer that gain, and if you hold it for like 10
10
years.
years.
It's 5 years step up.
Is it
10
5
years
years?
step
Some of it
up.
goes away. I think it's a great deal for real estate. I think it generally, I've not seen many deals where it works for angel investing. And you gotta have, if you're a real estate investor and you sold a building, you got a big gain, you got a big chunk of something, and you know that you're gonna do that. If you got a gain in a stock, it's because the company, you got a letter from the CEO saying, good news, General Dynamics has just bought our stock, and you're gonna get a check in 3 weeks. So it's hard to plan for that, but there are groups that are trying to do it. I looked into it and finally shrugged my shoulders and said the intellectual horsepower to make that work is more than I want to put into a deal.
Can you talk about the terms of convertible notes and sort of your insights on terms?
Sure. So
Maturity dates.
so let's start with a plain convertible note. It simply says, I loan you money at the next qualified financing, with some definition, you can convert this note into that offering at a discount of X, typically 20%. And then it may say in the interim period of time, you earn a little interest. Okay, so that would be sort of classic vanilla convertible note.
Yeah, I mean, think about like the concept behind a convertible note. It's terrible for investors, right? Because essentially what you're saying is, let me loan you some money, you use that effectively, raise the value of your company, and then I'll buy in at that enhanced value.
But my money got it too.
Without the cap.
Which is, I mean, that's
Yeah.
at the most basic level, like that's a great deal. And so what we tend to do, you got a discount when it converted, so, you know, otherwise you wait till that round to invest.
Which
You
is
get
what
some-
happens with the kisses and the safes, you just get whatever the price was with those guys.
in the future, yeah. But so now we've come up with, and it hadn't really happened on this coast very often, but this sort of irrational valuation increase. So, you know, I invest in your company today, you know, you're two folks and a dog and some code, and then you go out to the West Coast, this happened to us at Carolina Angel Network, and raise money at 25 million pre, like 6 months after we did our note. And they said, oh, well, you have a 20% discount. You know, we would never have invested at a 20 million pre, right? But we were locked in, and we didn't have a cap. So that, in that case, like the executive director of Carolina Angel Network said, we're never doing another note. You know, so it's,
Well,
I don't
so-
think the discount most of the time equates to the enhanced risk you're taking.
What about the length of time?
All right, so there's
one
two
more
other
question
questions.
on the cap.
Yeah.
Yeah.
So the
So
cap is
talk
just a
about the
conversion
cap.
cap, right? So that just says, all right, you're gonna get a 20%, the lesser of a 20% discount, or we're gonna, we'll treat your money as if you invested at a 3 million pre or something. So the issue with that is now you're negotiating a value. And so if you're doing that, just price the round, do a Series C documents. And now you know exactly what you own. And importantly, the founders know exactly what you own. What happens with us is people have a series of notes. We have this, if anybody wants to buy a medical device company, I got one for sale. They've done 3 rounds of.
We got our
notes.
buyer right over here. He's gonna do a podcast
Well,
on
that was
it.
a really bad sales pitch.
I'll sell it to you for the legal fees. But they've got 3 rounds of notes, and it's actually now like $2 million, and they've all got different terms
Oh,
and
God.
different. I mean, it's a dog's breakfast. It would be a huge impediment. It will be a huge impediment if we ever sell the company.
So I'll give you the other side of the story, and then we'll come to the length of the note, to the question on the caps. So the fix to this, you're using my money and you're making it really valuable, is a cap. So we had the entrepreneur that sold me the common stock, and 4 years later, she sold her company, and we made an IRR of 75% on our collective $500,000 investment. So it was, yeah, everybody was, woohoo, we're really smart, right? So she goes through her earn out and all that.
Maybe you should invest in a medical device company.
It was years ago, and I've already put the money back to work and lost it all. She comes back and she's ready to start her next company. And of course, we're like, Jessica, how much money will you take, kind of thing. And she'd gotten considerably smarter, and so she said, well, tell you what, I'm gonna raise, this first round's gonna be an uncapped convertible note. And I sat down with her personally and said, Jess, come on. That's not fair to the investors. No, that's what I'm gonna do anyway. So finally she said, all right, tell you what, I'll cap it at 10 million bucks. This is a company with nothing more than an idea at this stage, but a very successful entrepreneur, okay? And what did we do? We held our nose, we thrusted money at her, we put money in the convertible note, and damned if a year later she didn't have a Series A institutional round at a pre-money of $25 million. And so we got in at the price for $10 million, and wahoo. So it's possible that can work out, but I guess I would say if there's a best practice, is never invest in a non-capped convertible note. Now, you're doing some fairly lengthy notes.
Yeah.
And if we go back to where convertible notes came from, they were sort of always meant to be a bridge around. I'm kind of here, I've raised some money, I know I'm gonna raise money in about 6 more months, but I need $100,000 to get me to that point, so will you, as my favorite investor, will you loan me this money and I'll give you a discount when I get there, right? That's where it came from. And now they become this financing option for people. And so we were chatting about this beforehand. So what is a reasonable term on on a convertible note, the ones that I've seen are typically a year to 2 years. Okay? So what happens if you do one that's 4 years? You made an observation. If they then come and want you to invest in that deal,
Never, well, so we actually, we've seen 6 to 12 months.
six,
6 months.
oh, 6 to 12 months on the note, yeah.
I just wouldn't do anything like that. I mean, it's equity disguised as debt to begin with. I just think doing the long term, I just can't. And the problem we were talking about not being rewarded for the early stage risk, the longer the maturity date is, the worse that is. I mean, or that exacerbates that issue.
So the other thing I would say about that, if we go back to our rights, in a typical convertible note, you don't have many rights. But the one right you have is my note is due. And I'll bet I've used that a half a dozen times. And what we do, I have this company that does servicing for this, okay, is 90 days before that note's due, we send a letter to the CEO. Hey Alice, just checking in with you, you know the convertible note is due on May 1. Just want to make sure that you've got an offering coming or what your plans are to be able to cash this note out. Of course, you get a very horrified look from the entrepreneur who has long since forgot that that note has a due date on it. So, are they really going to pay us off? Of course they're not, because they don't have any money. It's kind of like the put. Are they really going to buy my stock back? No, but it does give you a seat at the table, and it gives you a little power in the transaction to say, okay, well, let's have some discussions about what we're going here. What do you intend to do about this? So, if that note is due 4 years out, the company's either failed by then, you didn't have anything to do with it, or it's gone on and raised more money, or it's in a zombie deal. I like having that limited power that I have to be able to pull that trigger early and force that conversation.
So we've seen a couple of deals recently, it's very recent, where historically in our practice, that conversion happens automatically. So if you're holding the note and there's a trigger financing, you convert it. We've seen a couple of deals in the last 6 months where that's optional.
Mm-hmm.
So the investor says, all right, I'll do what you want, but I'm not going to necessarily, I'm going to make a decision. I'm going to have the latitude to make the decision. You're not going to drag me into a round that I'm not going to.
So that's my next question. If you had an opportunity to stay in a note or convert, your thoughts on that?
So the
It's
question
a
is, if you have an opportunity to just continue the note or convert,
That's right.
whereas normally we're going to convert or we're going to be cashed out,
That's
right? But I don't want to convert, so I'm just going to hold the note.
That's right. Thoughts?
I've never been paid off on a convertible note, ever. I mean, I have to think about how many I've done, but it's several dozen. At least a couple of dozen. I've never been paid out. And I think that's a case-by-case decision. Do you like the terms of the deal that you're being converted into? I mean, if things are going well, I want to get into the capital gains calendar as soon as I can, right? So I convert. I mean, you can't pay me enough interest to offset the risk I'm taking. So I don't care about the interest. So that's my answer.
Yeah, I agree with you. And the other thing is, I want to get that clock running. And I certainly don't want a short-term capital gain, which I may be at risk. I've got the note, and I convert it to the stock, and the stock sells 6 months later. I can create more certainty, I think, if I get to the stock and I know what I've got and I know what the tax code says about it.
So the tax burden on the ordinary income versus capital gains, it's all kind of in flux, but it's roughly twice, right? So if I can get the capital gains, I'm going to pay 20% combined versus 40% combined.
And if I can get to section 1244, I'm going to pay 0 compared to 44%. That's even better. Who else wants to talk about something? Yes, ma'am.
In your opinion, how knowledgeable are the entrepreneurs on all of these aspects of the deal? I mean, have they do a lot of education around it, or is it not?
Well, we've talked to both. Generally speaking, not very. But I want to go through that Series C term sheet with them and make sure they understand every term and why it's there. That's part of the purpose of this, is to make sure that we're all on the same page. And if they really can't agree to a founder buyback provision, then I don't want to be in the deal. And let's find out about that early on. So I've done a fair amount of going around and giving talks to accelerators on this document. You know, but and I said, here's what we'll negotiate. We will negotiate the size of the round, the amount for first close, the price of the stock, the size of the stock option pool, the board of directors, and a percentage of the founder's stock that has to be escrowed. Other than that, it's not negotiable. You want it or don't want it. And so getting them to understand that, I think, is helpful. It also helps, of course, if they have decent legal counsel. And so I've walked away from deals where, you know, the attorney is, you know, basically trying to put a buy-sell agreement, an insurance-funded buy-sell agreement, and a bunch of other things that make sense for small business into one of these transactions. You've got to have somebody representing that company that understands we're selling securities. We hope that security is going to be bought by somebody, and all this stuff's got to be absolute whistle clean to get there.
So I like this question. My observation is, oftentimes even the recycled entrepreneurs can sort of hum the words but can't play the tune. You know, so they've said in a presentation like this maybe, but they're not really familiar with the details. But if they've got good advisors, it doesn't have to be the lawyer. You can get them there. But you know, we had a deal recently where we're looking at a deal, and the founder said, "I won't do a cap." And I went back to our person and said, "Well, they need to they need to explain to us why not. I mean, because they're not going to be able to. But if they understand it, they'll do a cap." But that's a tap, and it sounds like you do. Like we see part of our mission in helping with that education, and it's self-serving, but we see that part of it.
I'll give you another example on this, which is how do you value the thing? Okay. And of course there's a marketplace value, and you want the entrepreneur to have enough stake in the game that they're going to work 90 hours a week. But you can also make some formulaic stuff. So I build a spreadsheet. If you want it, let me know, and I'm happy to send it to you. It's on my website. That allows you to go in and say, well, how much will the company exit for? How much is my investment? And what value do I have to make my bogey? Assuming that I will be diluted. So those are the variables. So you put that in there and come up with, well, it's, you know, if it's only going to sell for $10 million, I can't give you a $4 million pre-money valuation. And you can do it the other way around. If I give you this pre-money valuation, what does it have to exit for? And I've gone to the incubators and taken the entrepreneurs through that math and said, look, this is the math that we're going to do. You should understand it. It shouldn't be, we don't want it to be mysterious. You know, we need to be able to make 10 times on our investment. You got to convince me this sucker's going to sell for more than $20 million in order for me to give you a valuation more than $1 million. And you know, so you can do that arithmetic, and I found that really helpful in working with entrepreneurs. To sit down and take them through that, say, hey, all you got to do to get a higher valuation is convince me that you're going to sell that for more than X dollars and why.
So the one way you should tell you that they're going to double, triple, whatever, in revenue next year.
Of course.
That they're going to sell $20 million in the third year. That's what I say all the time.
We've all got this hockey stick, right? Which just, how long is this part? And we know that we could probably double or triple whatever they're saying it's going to be, and cut this off in half.
Twice as long and twice as much money.
Anybody else want to talk about anything?
No, it's been great. Thanks for your attention.
Thanks so much for inviting us. It's great to be here.
Here we go. Anyone for, so we want to thank you. Thank you so much for coming and visiting with us.
You're very welcome.
Thank you very much. It was really great. Y'all, we have a membership meeting March 18th. It'll be at the main. Put it on your calendars. We hope you'll come. I'm in the middle of vetting 40 amazing applicants, and it looks like a really rich and interesting pool. So I look forward to seeing you all there. Thank you.
Great fun to be here.
Yeah.
Thanks for bringing me in. I enjoyed it thoroughly.